Okay, so let's dig in a little further. I know my analogies are crazy, but this is what really goes through my head. I see risk in a strange way. All right, so here I'm a black man, right? So I know people that have been driven by this, right? Victims and perpetrators, which is kind of wild, right? All right, so moving on. So here, if I'm looking to, let's say I want to sell a cash secured put. So let me just trash can this stuff away. And let's look at a cash secure put. So I want to earn some income from this. Well, this is also pre-programmed in here, right? So if I hit put, it's here, and also they've got what they call married puts, which is where you buy the stock and then you buy a put. The put is married to the stock. So let's just go straight to puts here, right? Okay, so if I am a buyer of a put, I'm going to buy to open, but I'm not a buyer of a put. I want to generate income, so I want to sell. Whenever you want income, you sell something. Whenever you do the first trade, you are opening the trade, and then when you close it, when you finish up, you're closing the trade. All right. So here, what I do is I jump in and I say, okay, let me sell to open one of these put contracts. Okay, so let's see, September 26th. That's tomorrow. That's too soon. So let's say I want to go out a month. I want to do this like a monthly kind of thing, a little bit like the liquid landlord strategy. So I'm going to go to October 24th, and my current price is 107. That's my frame of reference, right? And I'm going to answer two questions at once. We're going to talk about the cash secured put with an out of the money put, and then I'm going to go back to what Kevin asked about. Why would I sell an in the money put? Okay, so here I'm going to go to October 24th. Let's say I pick a strike. Let's say I look at this stock and I say I don't want to buy it at 107, but I will buy it at 105. Okay. So I could sell this put. What could I sell it for? That's a really good price, by the way. It's $8.70. So if I hit market here as the type of order, I usually do market orders. I literally could collect $869.48 for every 100 shares I commit to buying. Now, I don't know if this stock has an earnings announcement coming up or something. That might be why they're so pricey. Most puts are not going to give you, most contracts are not going to give you that much money for a put with that much of a distance between the stock price and the strike price. Remember, this is a volatile stock. Volatile stocks are the most interesting when it comes to options because they have the most what is referred to as optionality. They jump around the most. And when a stock jumps around a lot, it becomes really interesting for the options markets. The prices and the premiums get really high. So here, I this is my strike. Now, if I say, gosh, I really don't want to own this thing, I can pick a lower strike. I go to 103. Well, now I'm going to get 770. That's still not bad, right? I don't know. Let's go to 99. Lord, 5 9. That's still pretty good, right? Because remember, you're investing. What you have to do to cover this investment is you have to have an amount of money required to cover the sale in the event that the option gets exercised. So let me check the date. It's just, I mean, this is not bad. I like NBIS. This is a fun stock. I don't. It's very risky, but you can see there's a lot of ways to make money from it. But you just have to make sure you know what you're doing, and you're not gonna flip out if things don't go right. But here, literally $99. So literally, that's a massive discount on the current stock price. I could sell this put. I'm willing to bet you maybe that the stock went down today. Let me see. Let me see how the stock did today. I bet you that it went down. Um, and maybe it didn't. Let me see. Today, yeah, it went down by 4.5%. Okay. So I think that the reason the puts cost so much right now, and you can sell them for so much, is because people are worried about the stock price continuing to drop